If you think the Canadian housing market is on a straight path to recovery, think again. What I'm about to show you will change everything you thought you knew about interest rates, housing supply, and what's really driving the market in 2024. Rates are dropping, but that might not be the good news you expect. Stick around because by the end of this video, you'll know exactly where the Canadian market is headed and how it could impact your finances, whether you're a homeowner, investor, or just watching from the sidelines or hanging out in the comments. Hey everyone, welcome back to the channel. If you're new here, my name is Cameron and I'm a realtor in New Brunswick. And today we're diving into the most recent report put out by Edge Analytics, which will give us a crystal clear look into the Canadian housing market and some broader economic trends. We're going to break down what the Bank of Canada's recent jumbo rate cut means for your mortgage, what's happening with housing supply, and spoiler alert, it's not great, the cooling rental market, and a surprising surge in consumer insolvencies that I don't hear a lot of people talking about. This report is packed with insights that could help you plan your next move in real estate or just understand what's coming down the pipeline. You'll see charts, some data, and some examples that hopefully make it easier to understand what's actually happening behind these headlines. All right, first up, the Bank of Canada just delivered a massive 50 basis point cut today, and the market is already pricing in another 50 basis point cut by the end of the year. I'm sure you've seen every realtor share this on social media. Now, for most people, hearing that rates are dropping sounds like a dream come true. Lower interest rates mean lower mortgage payments, right? Well, yes, but there is a catch. What's happening here is part of a bigger strategy to stimulate the economy. Inflation has come down significantly, but it's not because everything is cheaper. It's mainly because the cost of housing, specifically rent and mortgage interest, is driving the inflation down. Here's a chart that shows the components. Now, with this rate cut on variable mortgages, the monthly payment on a typical home will drop by about $23.76 for every 100K borrowed. So in my market, on the average home, you're looking at about $1,140 per year in savings compared to 4 months ago. Also, if you don't know, please note that fixed rates have already been priced into a lot of these rate cuts. But here's where things get tricky. Edge points out that before this cycle is over, we'll likely see the loonie retest an all-time low around 62 cents to the US dollar. This will ultimately facilitate the rebalancing of the Canadian economy away from housing and consumption and back towards manufacturing, but it does risk stoking inflation. A weaker dollar means imported goods like food and energy will get more expensive. That's how inflation sneaks back in, and we're caught in a cycle. So while lower rates sound like a win, they could lead to rising costs in other parts of the economy. Personally, I think it's a bold but risky move. The Bank of Canada is betting that lower rates will kickstart the housing demand and economic growth, but the weakening dollar could create new inflationary pressures that we'll be talking about next summer. Now, let's talk about housing supply, or rather, a lack of it. This is one of the most important factors influencing the future of the Canadian housing market. And here from the Edge report, it shows that housing starts are down over 18% year over year. This is driven by a massive 30% drop in condo starts, particularly in Toronto, where developers are facing slow pre-construction sales. Why is this important? Well, fewer new homes being built today means that we could be facing a severe housing shortage in the next few years. The report predicts that by 2028, there will be a dramatic undersupply of condos, which could push prices up. So while prices may be stabilizing or even falling in some markets right now, the long-term outlook suggests that we're going to see an upward price pressure once the demand returns. And it's not just condos. The single-family home market is seeing similar issues across the country. Housing starts for single-family homes are at a 40-year low, especially in BC and Ontario. And with population growth still outpacing new housing completions, we're looking at a long-term supply crunch that will only get worse if new builds don't pick up. The kicker, this slowdown in construction could hit the job market too. The report shows that construction payrolls have already started to decline, and if this trend continues, we could see layoffs in the construction sector as fewer projects break ground. This is a huge red flag. While demand might feel weaker today, we're sowing the seeds of a future housing supply crisis, and we're already in one now. If you're thinking long term, and you should, now might actually be a great time to buy, especially if you can lock in at lower rates. According to the Edge report, rent growth has dropped to just 2.1% annually, which is a massive drop from the double-digit growth we saw during the height of the housing boom. This slowdown is partially due to a record number of new rental units that have been hitting the market. In the past year alone, we have seen about 81,000 purpose-built rentals completed, along with 60 some odd thousand condo units that are being rented out. The surge in supply is finally easing the pressure on renters, but there's another factor at play here: the non-permanent residents. International students and temporary workers have been a huge driver of the rental demand, especially in major cities like Toronto and Vancouver. Now, with new federal rules tightening up the flow of temporary visas, we're seeing a slowdown in that cohort. As a result, rental demand is starting to soften, but don't expect rents to stay low forever. As soon as demand picks up again, with fewer new projects coming down the pipeline, rents could quickly start to rise again. This is especially true if affordability issues continue to push more people into the rental market instead of homeownership. After a slow start to the year, mortgage originations were up by 3% in August, driven by an 85% jump in variable rate mortgage originations. This is a sign that buyers are starting to return to the market, especially as rates fall, as the news media is reporting. There's a catch. New regulations are coming into play that could slow down this recovery. The Office of the Superintendent of Financial Institutions, OFSI, is introducing a new loan-to-income LTI limit that is set to kick in November 1st. Essentially, banks will only be able to give out a small percentage of mortgages to highly leveraged buyers, those whose mortgage amounts are more than 4.5% of their annual income. Why does this matter? In previous housing booms, we saw that a significant portion of new buyers took on high levels of debt relative to their income. By capping this, OFSI is trying to prevent another speculative bubble. But it also means fewer people will qualify for mortgages, especially in expensive markets like Toronto and Vancouver. To me, this is a smart move to keep the market a bit more stable, but it could have an unintended consequence of keeping more people locked out of home ownership. If you're a first-time buyer or someone with a lower income, you'll need to plan carefully and perhaps adjust your expectations for what you can afford, or potentially looking in an alternative market. Here's a stat that's not getting enough attention. Consumer insolvencies were up 8.9% year over year in August. That's concerning, but what's really alarming is the dollar value of those insolvencies jumped by 30%. What does that mean? Well, it means people are defaulting on bigger debts. The report shows that while overall credit delinquency rates are still relatively low, Ontario is seeing the largest increase in mortgage delinquency in over a decade. This is a huge red flag for the broader economy because if more homeowners start missing mortgage payments, we could see a wave of forced sales hit the market. This would flood the market with inventory and could push prices down even further. But the problem doesn't stop there with mortgages. Credit card debt is also rising fast, growing at 3 times the rate of lower interest rate mortgage debt. This shows that more Canadians are relying on high interest debt to cover everyday expenses, which is a sign of deeper financial stress. If unemployment rises or wage growth doesn't keep up with inflation, we could see insolvencies continue to rise. Insolvencies are like the canary in the coal mine. When they start to rise, it's often a sign that the broader economy is facing trouble. If you're a homeowner struggling with debt, now is the time to take action, perhaps refinance, or you could look at ways to cut down on your high interest debt before things get worse. So, what does this all mean for you? Whether you're a buyer, a renter, or an investor, here's my take. For buyers, now might seem like a good time to jump into the market, especially with falling rates, but be cautious. The long term outlook suggests that while rates might drop further, the weakening Canadian dollar could lead to inflation in other areas, making things like groceries and fuel even more expensive in your day to day life. For renters, the good news is that rents are finally cooling a bit, but it's likely temporary. With fewer housing starts and more people potentially priced out of the buying market, rental demand could rise again, pushing rents higher in the coming years. If you're looking to lock in a rental, now would be a good time to negotiate before the market heats up again. For investors, it's a tricky time. The slowing housing starts signal that supply will be tight in the long run, which could push up property values. However, if the economy weakens or we start to see a wave of insolvencies, the short-term picture might look bleak, especially in condo-heavy markets like Toronto. You need to play the long game, but be prepared for volatility in the next couple of years. So what do you think? Will the Bank of Canada's rate cuts be enough to keep the housing market afloat, or are we headed for a downturn? Let me know in the comments down below. If you found this video helpful, make sure to give it a thumbs up and hit subscribe. To sum it all up, the Canadian housing market is at a pivotal point. While lower rates may help drive demand in the short term, the long-term challenges of limited housing supply, rising consumer debt, and a cooling rental market create a complex environment that will require careful planning and strategy. Whether you're buying, renting, or investing, now's the time to be smart, stay informed, and make decisions based on data, not just the headlines. Thanks for watching, and until next time.